Welcome, it's DC. In today's video, I'm going to be showing you a new scalping strategy that you can use to trade Volatility 75 index. So if you're new to my channel, please kindly subscribe, like and share. Don't forget to hit the notification bell so that you'll be notified whenever we release new content. So in this particular video, we're going to be giving out a Volatility Killer EA. We have a Volatility Killer EA that we're giving for free. So what you have to do is this. You just have to make sure that you subscribe, like and comment. Send me a screenshot on the number that is appearing on your screen, or on the number on the details that are there in the description. Then you'll be in a position to get a free EA. Apart from that, you have the opportunity, if you subscribe, like and comment, to join our Volatility Telegram group, where I'll be sharing at least one signal per day in that particular group. So let's quickly look at the settings that we're going to be making use of in this particular strategy. So let me quickly delete these settings and let's look at the settings. So this strategy can also be used on a phone. So we're gonna make use of, under B. Williams, we'll be looking at the Alligator. We're gonna make use of the Alligator. So we're gonna see how we can trade using the Alligator. So the settings for the Alligator will be as follows. So the parameters for the first, we have the jaws, the jaws period. We have the these are basically the default settings. So we have the jaws period of 13, shift 8, then teeth period of 8, shift 5. Then we have the lips period of 5, shift 3. Then the method is smooth. Then apply to medium price HL over 2. So basically these are just the default. Then the colors, we have the following colors: dark blue, red, dark blue for the juice, the teeth are red, then the lips are lime, then with the following pixels. So I'm just doing this so that you guys can see nicely. So when you're done, you have this following Alligator. So the analysis that that we can use when you're using the Alligator is basically, when you look at the Alligator, the Alligator's head, it is a what? It is the jaws, which is this blue line. It has the Alligator also has the what? The teeth. Then we also have the Alligator's lips. So the analysis is this: when the Alligator opens its mouth, that's when it will be it will start devouring the what? The bears or the bulls. It will start eating the bulls or the bears. So in this particular example, we'll look at how we can now use this analysis to what? To trade. So one, when you're using this strategy, you don't want to trade when these lines are crossing. So according to the analysis that is there on this Alligator indicator, they say that during this period, when these lines are crossing each other, the Alligator will be asleep. So you want to trade when the Alligator is awake. How do we know that the Alligator is awake? When these lines are now moving away from each other, they are far away, there's distance between these lines. That's when we want to start trading. So let's quickly look at how we can sell using this indicator. So what you want to do is this: since this is a scalping strategy, you want to come to the H1. On your H1, you have to make sure that one, the lines are far away from each other, indicating that the Alligator is now eating, it is now feeding. There is a trend. So when these lines are far away from each other, it means that there's a trend. And when also these lines are pointing downwards, it means that there's a downtrend. So you want to start selling in Volatility 75 when one, on your H1, these lines must be far away from each other. That's one. Secondly, they're also pointing downwards. And thirdly, the candles, these candles that you see, are below this Alligator's jaw, which is the blue line. So those are the conditions. Once that is the case, from this particular period, we'll start from the when was it? It was around here, the 3rd of January. That's when we're gonna start looking for selling opportunities. So now you've confirmed all these conditions. You then have to move to your 5-minute time frame. On your 5-minute time frame, we said the 3rd, during this period. On your 5-minute time frame, you are also going to avoid trading when these lines are crossing each other. The Alligator is asleep. You want to trade when these lines are now moving far away from each other. So the thing that the problem with the alligator is this: when you're using the alligator, the original method is that you wait for the crossing of this red line. That's when you start. When this red line crosses above the blue line, the dark blue line, that's when you can start selling. But it gives a late signal. So in this particular scalping strategy, we've developed a way that you can get an early signal, and it also gives you what, an area where you're going to be placing your stop loss, and also where you're going to be exiting. So one, you want to wait. So starting from this period, we're looking for selling opportunities, and we want to start trading when these lines are separate, like what we see at this particular level. So one, you want to wait for the price to close below the red line. So once price closes below the red line, we have this bearish candle here, this red candle here. We can see it was the first candle that that closed below this red line. And when that candle closes, you have to sell on the next candle open. Basically, that's how you'll be selling. So you wait for a candle to close below the red line, and you sell. You then take your sell position at that particular level. So on your 5-minute time frame, when you drop down to your 5-minute time frame, what you want to see is this: the lines will also have to be far away from each other. That's the first thing, and they must also point downwards. So don't trade when the alligator is asleep, when these lines are crossing and are almost horizontal on your screen. So how are we going to enter our sell position? We want to wait for price to make a pullback. So we want to wait for price to make a pullback, like what took place at this price at this particular level. So in a downtrend, these lines will act as resistance. They're dynamic resistance levels or support levels. So we want to wait for price to make a pullback. So the pullback will occur on the red line or the green line. Those are the pullbacks that we'll be focusing on. And we want a candle to close below the red line. When that takes place, you then have to place your stop loss. When your stop loss will be just above this red line, this particular line, the dark blue line here. This is where you're going to be placing your stop loss here. So that means if price closes above this blue line, if price closes below this blue line, that's when you exit your position. So this is where you place your stop loss just above that line, or you can make use of the previous swing high. This one, this low high here, you place your stop loss just above this particular level here. But as long as the price closes above this blue line, you don't wait for price to hit your stop loss. You immediately exit that position. So if you have a bullish candle that is closing above this dark blue line, immediately exit that particular position. So you hold that trade. So the advantage of using this trade is that you can hold the trade for a very long time. How are you going to hold the trade? As long as price still trades below this red line, which is the teeth. If price trades below the teeth, this red line, you hold your position. You hold your position. You only exit when we have a candle like this particular example here. We have a candle here that resulted that closed above this red line. We exit that position. So that means we're going to enter at this particular level. We're going to enter here, and then we're going to exit here. Look at the risk to reward. This was the risk that we had. This was the risk, and look at the reward. So this strategy is amazing, guys. It's amazing. Then you wait for another entry. So here in this particular example, as long as price is on the 1-hour chart is below these moving averages, you have to wait for a second entry. You'll be basically selling in that particular example. So here, when we have a candle closing below this red line, like here, we're going to open a sell position, and our stop loss, we're gonna place it just above the previous swing high, this one. So our stop loss is here, but if you have a candle closing above the blue line, we exit, and then we are in that trade, and we close it here when we have a bullish candle closing above the red line here. So this is our trade here. So here, the disadvantage of using this strategy is that we don't have a fixed risk to reward ratio. And we can see here price, then here we're going to close. So it was a winning trade. Then let's look at this particular example again. Let's look for another example. So on this example, we can see price closed below here, price closed below this red line at this particular level here. Price closed below the red line, and our stop loss was going to be placed above the previous swing high, which was here. So we're going to get an entry here where we have the candle closing below the red line here, and then we're going to exit when we have a candle that closes above that red line. And here, this is where we're going to exit. So we'll enter here and exit at that position. Our stop loss just above the previous swing high here. And then so we are going to sell on the next candle open when that red bearish candle closes below the red line, and then we hold the trade as long as price is trading below the red line. So we're going to exit here. Look at the risk to reward ratio that is there in this particular strategy. So it's one of the most powerful and accurate strategies that you can use to trade in volatility indices. So let's look at how we can buy using this strategy. So one, we have to make sure that the lines, the price is above the what? This alligator, these lines, and these lines are not, they are pointing upwards in this distance. These lines are also spread, they are far away from each other. So that's the first condition. Then if that is the case, and these lines are pointing upwards and they are moving away from each other, there is also a trend here which is indicating a bullish trend. So we have a bullish trend on the what? On the 1 hour time frame. We go to the 5-minute time frame and we look for a buying opportunity. We want to buy when a candle closes above the what? A candle closes above the red line. In this particular level case, we had the price closing above this red line. Our stop loss is going to be placed just below the previous swing low, which is this particular level. This is where we're going to place our stop loss. And then we hold the trade as long as price is above the red line, this red line. And if a candle closes below the red line, like what took place here, price closed below the red line, we're going to exit. So for this particular example, we're going to enter here and then we're going to exit here. Our stop loss was here, so we can see we have a good risk to reward ratio. Let's look for another opportunity where we're going to use this particular strategy. So here again, we don't trade here. We don't trade. Why? Because the lines are not pointing in any direction and the lines are crossing each other. So we wait for a trend. The trend will start to exist when we have these lines spreading away from each other. They're far away from each other. Then you wait again for a pullback, and the pullback occurred at this particular level. We have a candle here. We had the pullback. This is the pullback, and the price pulled back to the red line. So the pullback can occur on the green or the green line, or it can occur on the red line. In this particular example, the pullback occurred on the red line. So these lines now, when they're in a bullish trend, in an uptrend, they now act as dynamic support levels. So we can see price was supported at this particular level when the candle closes above the red line, which took place at this candle. This is the candle that closes above this red line here. So that means we're going to buy when price closes above that red line. The next candle open was this one, and then our stop loss was just going to be just slightly below this. So this is the swing high. We can't place it here. We need to place it just below this particular level. So here, this is where we're going to place our stop loss. Then we hold the trade as long as price is trading above the red line. So we're going to hold the trade and exit when price closes below the red line. So in this particular example, since our high time frame is bullish, so we'll be looking for bullish setups only. So let's look for another example. Okay, here again we have, on this particular example, we have price closing above the red line, which took place roughly around this area here. We have a candle. This was the candle. We had a price moving up, and then we had the pullback. This was the pullback, and then price then started to move upwards. So on this pullback, we want price to make a pullback on the green or the red line. So the red line is one of the strongest. When comparing the green and the red line, you would want to take most of your trades on the red line. And then here we can see price made a pullback, and here we have a candle closing above. We see this one, it went below, then it closed above. So here on this particular level, this is where we're going to take our buying position here, and our stop loss was going to be placed just below the previous swing low, which was here, and then we're going to buy. But we should bear in mind, if a candle closes below the dark blue line, we're going to exit the position. That let's look at how. So we're going to buy here, and here we had a small drawdown, but eventually the price then started to move upwards, and then eventually price closed below here. So we're going to exit at this particular level. So let's look for one more example of. Okay, so this will be our last example. So what we can see is this: during this trade, there was consolidation. We can see this because of the fact that the lines were crossing each other. So like what we said, the alligator will be asleep. We don't take any trades during this trade. So we wait for the lines to start to move far away from each other, which took place here. We can see starting from this position, we had a trend here. So we want to start looking for buying opportunity on this particular level here. So here we have price moving up here, then we're going to wait for a pullback. The pullback took place at this particular level, and the pullback occurred on these particular levels here, and we can see we have a candle closing above the red line, which was this particular bullish candle here, and our stop loss was going to be placed below the previous swing low. So this was the previous swing low, this was our high low. Then we're going to what? To hold the trade as long as price is trading above the red line, and when price closes below the red line, we exit. So we're going to exit at this particular level here. So our stop loss is here, but we exit when the price closes below the dark blue line, and then we hold the trade as long as the price is above the red line, and we're going to exit here. So what I've noticed is this: do you see that if we had a fixed risk to reward ratio, so this is how you can now improve the strategy. Having a fixed risk to reward ratio will allow you, instead of you losing some of your profits, and look, this was a drawdown, some of your profit was taken out. So having a fixed risk to reward ratio, maybe 1:3 or 1:2. So I will stick with the 1:3 risk to reward ratio. So here, if I'm risking, so this is the risk that I'm risking, it's about 35%, 0.35. So I'll multiply that number by 3 and get the percentage of the my take profit. So here what I'm trying to say is this: so if I'm risking $1 here from this particular level here, if this is $1 here, if I've calculated my stop loss to be as $1 from these pips here, I'm going to multiply. If I get $3, I should exit. So that's maintaining a fixed to risk reward ratio. But looking at this particular example, we have 0.35. So I'm now working with percentages. So we have 0.35, we multiply it by 3, we get 1.05. So 1.05. So if price moves by this percentage from this trade, 1.05, which is somewhere around this area, I must be in a position to close. So you maintain that fixed risk to reward ratio, you will see that you'll be in a position to make more money. So if you are risking $2, make sure that you take a profit when price reaches $3. That's maintaining a fixed risk to reward ratio. So for the promotion on this particular video, make sure that you send me a screenshot. Make sure you subscribe, like, and comment. When you're done, send me a screenshot on the details that are there in the description. Then you'll be in a position to get a free volatility killer EA that can be used for scalping. So basically, this indicator, this EA, is used for what? For scalping. So it's a trading robot that we can use for scalping, and you can get it for free by just making sure that you subscribe, like, and comment. And we also have our mentorship program where we'll be teaching you how to trade different financial assets. You are in a position to trade derivative synthetic indices, your boom and crash volatility, your step index. Then we also have you'll be in a position to trade any asset. So if you are interested in trading what? Gold, if you're interested in trading NAS 100, if you're interested in trading cryptocurrency, we have a mentorship that is tailor-made for that. So basically what we will be teaching in this mentorship program, we have price action, we have smart money concept, we have indicator-based strategies. So these indicator-based strategies, they can be used in different financial assets. Then we also have risk management. So we also have our VIP signal where we'll be giving derivative synthetic indices signals on a daily basis. So we focus on booming crash, volatility, then we also have step index and also jump indices. Then we also have our spike detector, DC smart spike detector, which you can also get. It's a paid indicator, so if you're interested, you can get in touch with me and you can get that indicator. Then we have different EAs that can also be paid EAs that can also be used to trade volatility indices, then booming crash, and also step index. Then recently, in 2024, we've created the Optimus EA. This is the new EA that we've created that can be used to trade Boom 1000 and also Jump 25. It's an EA, a trading robot that can be used to trade on a 5-minute time frame to trade boom 1000 and Jump 25. If you are interested in getting that new 2024 trading robots that I've recently created, you can get in touch and you can also request for the statistics for this particular indicator. Thank you so much, guys, for your time. Enjoy your day. It's bye bye for now.